I don't say I'm planning for a wedding. What I'm paying for is a marriage.
You don't have to.
I don't have to, but I believe in them.
How many times have you looked at your wedding photos?
People think conservative investing is not volatile, and that's not true.
Welcome to 5QIQ Financial Power-Ups from Trajan Wealth. I'm Trajan Wealth's Chief Investment Officer David Busch with fiduciaries Marty, Bryant, and Corbett Leduke. Most people think bad investing comes from bad information. Often it comes from good people making the same emotional mistakes over and over. Today kicks off with this. How do I detect and avoid common behavioral biases that silently erode returns? If this is something you've struggled with, share your experience at trajanwealth.com/5QIQ. So let's talk about biases. How do they erode returns over the long term?
Well, if you get emotional in a volatile stock market and decide, I have to sell. And then you don't know when to get back into the market.
But is that really an emotional bias, though?
It's a bias to volatility.
And it's a loss aversion bias.
Mm-hmm.
Okay. I see what you mean.
Mm-hmm.
Yeah.
Okay.
Yeah.
Yeah, because I mean, yes, it can feel good to sell and say, "Oh, I'm saving myself," but you better know when to get back in.
And most people
And that's the part that most people fail at. You're absolutely right.
Timing the market, you can't
It's
do
time,
it.
it's
Yeah.
time in the market.
Yeah.
And knowing that, okay, finding that level of risk
Mm-hmm.
that you are comfortable with, knowing that, can I handle this
Mm-hmm.
or can I handle this? If you can only handle this, but you've got this, then you are setting yourself up for failure.
Right. And you need to, rethink what you go back and rebalance so that you
Right.
can put it back into a beta or a risk that you can handle.
Right. Because it's too hard to try and get it right.
Now, on the opposite side, you have status quo.
Mm-hmm.
I've owned Apple forever and ever, or I've owned the stock forever
I've owned
and
GM
ever.
forever. Ooh. Yeah. How'd that work out?
Right.
That's right.
But you can get complacent as well.
Right.
Yeah, the other one that I think of is competency bias. And so I'll use myself as an example here. Over the course of my career, I've traded and invested billions of dollars across asset classes, and I have access to all the information in real time at my fingertips through my Bloomberg terminal.
Right.
I also have access to strategists and economists, and I read all this stuff. And so, for me, it's like I have to be aware that, yes, I'm a professional. Yes, I've been doing this for 26 years. But at the same time, I have blind spots. And so for me, a long time ago, I'm talking this is probably 20 years ago, I made the decision that for my personal account, I set it up very similar to how we set up our clients' accounts.
Mm-hmm.
I use low-cost ETFs. I don't trade individual stocks. I don't trade individual bonds or options or anything. I have the understanding and the knowledge to do it. But at the same time, I wanted my focus to be on our clients and their returns. And for me, it's like just putting it almost on autopilot in a lot of ways, because you can start to think, oh, I see patterns, or this is the recent experience that we've had for the Mag 7 as an example. And it's like, well, yes, that has happened, but will it continue to happen into the future? And the truth is we don't know.
Mm-hmm.
Right.
Or how about this scenario? Because, and for the people who are just joining us, this is David's second time with us, and he is not an advisor. So what you do on the investment side is not what we do on our side of the fence, right? So we talk to people about where they want to be, and we choose in the clients, right? So one of the scenarios that has happened numerous times over the years, because we've been in this for more than 20 years, are the people who don't think they need an advisor because they know more. How are you going to help me?
I mean, like doctors and attorneys and things
right.
like that.
Yeah. To name a few. And then eventually they come in because they destroyed their retirement. They destroyed their accounts by being overly confident. I know, I can do this. You guys can do it. I can do it. Right. I have all the information at my fingertips. And then next thing you know, they're coming in. Okay, I blew it all up. I didn't know what I was doing, and I admit it.
That's right. And that can happen. And on the loss aversion side, when I think about that, it's the market has volatility.
Right.
We've been spoiled in this country because over the last 15 years, generally speaking, I know we had a little bit of a hiccup in 2022, but generally speaking, the market has gone up.
Mm-hmm.
But I cut my teeth in this business on the .com bust and then the global financial crisis.
Mm-hmm.
And so I experienced those market sell-offs, those big dramatic,
Oh,
market
yeah.
sell-offs early in my career. And one of the keys that we continue to talk to our clients about is to be patient, think long-term, stay invested, because when we do experience market volatility, and I'll give you, for example, I was in New York having lunch with one of our colleagues who's also an investment manager. And this was right after the election and the market had sold off pretty dramatically. Well, there was one day and Matt and I were at dinner or at lunch, and he looked up at CNBC and he said, the Dow's up 3,000 points that day.
Mm-hmm.
And so you have those dramatic swings. And if you sell at the top or sell at the bottom and try to invest at the top, I mean, that's
never gonna
going to
find it.
quietly erode
Losing
your
proposition.
returns.
You'll
It
never
is.
find
It
it.
is.
Right.
So I think it's important for people to remember that there are millions of sophisticated investors around the world
Mm-hmm.
managing and trading and investing in all different types of asset classes. And for us, it's like, hey, there's going to be sell-offs, but stay invested, because
Mhm.
what we've seen is that the size and magnitude of bull markets is substantially larger and lasts longer than the sell-off.
Right.
So stay invested. That's the easiest thing
Well,
to do.
if you look at the near term, the Iran war, if you had sold on March 7th and just cashed out, you would have cashed out at about the ultimate market low, because you're like, oh, this war is going to be horrible, all those things. From that trough or that bottom to where we're at now, you would have missed out on roughly probably 17% in probably 6 weeks. Those kind of moves don't happen very often. And if you miss them, it's hard to make that back up.
Yes, it is. You're behind the 8 ball.
One of the things I often think about is when volatility increases, that's the time to start investing or to
Oh, yeah.
continue dollar cost averaging in. It's counterintuitive because that typically means that there's a market sell-off, but that's actually the time to step in and buy more.
Yep. Volatility creates
Generally speaking,
Volatility creates opportunity.
But
does.
inherently, we're already doing dollar cost averaging in our employer-sponsored plans,
True.
right? You're already doing it, whether you know what it is or not. You're just investing systematically, no matter where the market's at. That
That's right.
is and the highs and the lows. But
Yep.
over time, just because
It
you've
smooths it
invested,
out.
you will get those compounding returns
Exactly right.
over time.
That's right.
Yeah. So one thing I like to say to my clients, when they come in and talk to us, sometimes people have it in their head that we need all of their money. We need to manage all of your money, otherwise we're not going to have a relationship. And
That's very true. We need all of their money.
no, we don't.
We
Corbett.
would like
We'd
to have
like
all
to.
their money, but
So this is what I say. Maybe that's why I have more clients than you. So this is what I say is, no, I don't need all of your money, but why don't you let us take care of your lifestyle money and whatever it is that you want to have on the side because you want to continue to trade and do things, you go do that. Let us manage your lifestyle.
If they want to do that.
Because if they want to, yeah, I'm not going to tell you no, right? I'll talk to you about it. We'll talk about the pros and cons of what it is you want to invest in, but we can help take that emotion off the table for you.
that's right.
You need to trust us to do what we do best. And since that's not what your job is, you can't trust yourself to do.
And for a lot of people, they are what's called time bankrupt.
Uh-huh.
They just don't have any time to manage it. In fact, I had a client just this past week, 28-year-old. She has everything on track. She worked at Schwab for 5 years, and she's like, I just don't have time to do this.
Mhm.
I know that by hiring you guys will keep me on track and all those different things that I haven't been doing that I should have been for the last 2 years.
That's right. And the last thing I'll say with this discussion is that, given the bull market, the recent bull market that we've experienced specifically in the Mag 7, it's easy for people to see those returns and say, I want that type of return, and to think that it's going to continue to last.
Yeah.
Right.
And the truth of the matter is that when we meet with our clients and we determine their risk tolerance, which is their ability and willingness to tolerate risk, we have to advise our clients, like, you may want these Mag 7 type returns, but are you comfortable with the downside volatility that
Right.
may happen?
Oh, yeah.
And so really it's getting back down to, don't chase those returns.
Mhm.
Set up a plan that's evergreen, that you can continue to invest in over time.
Mhm.
And in my mind, it's better to hit singles and doubles than to swing for the fences and strike out. So be comfortable with both the upside as well as the downside.
Mhm.
Right.
Diversify,
Diversify.
create checklists for yourself,
Yep.
Find the level of risk that's comfortable for you.
and long-term investing.
That's right. Great discussion. Our next listener asks, how should I use leverage responsibly for real estate, margin, or business? And when is it too risky? If you've ever wondered whether borrowing is helping or hurting, tell us at trajanwealth.com/5QIQ. All right, so let's talk about borrowing. So that's leverage is another word for borrowing.
Right.
So let's talk about debt financing, borrowing, leverage,
Margin.
How does that impact returns, and when is it safe and responsible to use it?
Sure. So, I mean, if you think about it, so what's the number one use of leverage or borrowing? Mortgage. That's
Yeah, real estate.
for most people for real estate. So you're buying a stable asset that you're not really worried about it dramatically going down. Let's exclude 2007 to 2010.
The financial crisis.
Financial crisis. And knowing that for most people, yeah, they can't afford to put down $400,000, because if you're saving that $400,000, you may never get to that point compared to, hey, I've got my 20% saved down now. I'm going to borrow $320,000. I'm going to put down 80. At least I'm into a home now. Now, if you can make extra payments along the way to decrease your principal balance over time, then fantastic. But also on the interest rate. I have a lot of clients that come in and say, yeah, I've got a mortgage, $200,000 at 2.5%. And I tell them flat out, do not ever pay that off, because the ability to lose that interest rate, but more importantly, you've now lost that liquidity. You can't have that liquidity back.
I think we're talking more in this conversation more about how I'm borrowing to do something else with that money. So in this instance, we could correlate that to
So like a home equity line of credit?
so like a HELOC. Okay, so stick with me on this. So during COVID, all these people jumped on the bandwagon and started buying these homes, or before COVID, they were buying all these second homes and third homes to do VRBO and all of that. And because they thought they could afford it, but they didn't sit down and really look at the numbers. Can I afford this if it's not rented?
Right.
Can I debt service this loan myself? So maybe I have all this equity in my house. I'm going to take out a home equity line of credit. I'm going to use that HELOC to turn around and buy some real estate so I can have passive income, or so I can do these VRBOs. And then what happened when people were no longer doing VRBOs? When COVID was over and people started traveling normal again, now we have seen numerous families, now they are responsible for making these mortgage payments
2 payments,
or 3 in some cases, that they can't afford to make. That is the kind of margin I think we're talking about, or leverage.
Right.
So now what I've done is I have
over leveraged.
And now I'm also responsible for paying back that HELOC. Home equity lines of credit typically are higher than your traditional mortgage rates. So I think that, am I kind of going in the right direction, David?
Yeah,
what do you think on this?
I think that's right. And when you think about borrowing money and investing, whether it's real estate or the equity markets, really it's the question you have to ask yourself is, one, can I afford this debt service even if things don't go right?
Mm-hmm.
And things don't always go right, which is
Can you afford the margin call?
Can you afford the margin call? And so if you're investing in a cash flow producing property and you can make that debt service payment without those cash flows coming in, without that rental income, then it may be okay. But what we also see, and going back to margin, is we've had these outsized equity returns over the last several years.
Right.
Well, many investors think, well, if I can borrow on margin and invest more, it'll amplify my returns. But leverage can also work against you in that scenario, because if the market doesn't move the way you think it's going to move, then it can amplify your losses.
Yep.
So you have to be very, very cautious with margin and borrowing, just in general.
Right. Especially,
Yeah. Especially margins generally correlated with the stock market.
Right. I mean, if you're going to do margin, if it's a short-term need, like a bridge loan, something like that, okay, I get that. Or, hey, I'm going to take advantage of it, but, being on it long-term is really hard to get right. Because to your point, that if the market turns down, like we just had in March, then, that 9% turn, and if you've got 50% margin, that means that return, that negative impact is going to feel like 18%, because you have now portfolio that's twice as big as that you would have with just the pure cash.
But what is a bridge loan for? So remember when all the people are flipping houses, and you get a little bridge loan for flipping the house, and then suddenly the real estate market falls out. You're in the middle of trying to flip a house.
That's right.
once again, you can get caught with your pants down.
Or extreme like hard money loans. Like,
Yeah.
oof.
Yeah, that's right. That's right. So I would just be cautious and just remember that leverage can amplify the upside, but it can amplify the downside as well.
Mhm.
And the equity market history is layered with hedge funds that have blown up because
Oh,
of
yeah.
too much margin, and
Mhm.
companies that have blown up because of too much margin, because of too much debt.
Yep.
So debt in and of itself isn't necessarily bad, but too much debt can make us weak.
Yeah. And you're not going to do short-term loan for long-term debt,
That's
Right.
right.
right?
Exactly. So now for a planning question. Every family needs, but too few actually prepare for. How do I design an emergency fund that balances liquidity, returns, and inflation risks? That's a big one. The emergency fund is a big one.
Yeah, emergency fund's got to be liquid. I mean, hands down, number one. So that's, I think, the biggest challenge I see for most people with their emergency funds is that they think that it has to sit like in a checking account. No, it doesn't. Liquidity can mean different things, but even if you invest it, say like in a money market or an ETF or a mutual fund, you're going to have the availability to have those funds back into your bank account, typically within 2, maybe 3 days max.
Mhm.
So as long as you haven't gotten kidnapped by the cartel, you're probably going
'Cause
to
you
be
didn't-
okay.
Because you didn't have a trust.
Yeah,
And
the
you had too
trust.
much margin with them.
Or yes, exactly, all those things, and you were buying drugs and then amplifying
Yeah.
to do that. As long as you're
Compounding your
avoiding those
losses.
things, but and that's the biggest thing. Is like, yeah, I've got $80,000 sitting in my checking account. Okay, you have these options.
Mhm.
If you know that you're going to be using it in the next 2 years, yeah, there's no reason to be investing that in the stock market.
Right.
Just hands
So
down.
maybe just keep 1 to 2 months worth of expenses liquid in a checking account.
Right.
Right. Just 1 to 2. And then the additional funds that you've saved, you can go to a high yield savings account. I know it feels counterintuitive right now. What I do with my clients, I'll go online. There's websites you can Google for, high yield savings account. I personally like to use Nerd Wallet,
Mhm.
and Nerd Wallet is going to bring up these companies that are non-brick and mortar. That's why they can give you a little bit higher interest rates. Just make sure FDIC insured or a
Right.
company that you recognize them, like Allied Banks there. You've got Amex, American Express
Not Dewey,
sometimes.
Cheatham, and Howe.
That's right. And maybe put some of that money over there. I've seen some pushing 4%.
Yeah.
Right. Certificates of disappointment.
Oh.
I wouldn't recommend doing a 6-month CD. Some people think I'm getting 4%. That's your annual. You're actually
Right.
getting 2% for 6 months.
Right.
People don't really realize that when they do it.
They don't.
Oh.
And then they like to argue, no, it's 4%. No, honey.
That's the APY, annualized percentage yield.
Annualized.
Exactly.
Yeah.
Right.
So,
And 6 months, give me half of that. If you
Look,
do
if
it for
it's
90
2.
days, it's a fourth of that.
Yeah.
So is it generally like call it three months in a cash or cash-like savings account, and then beyond that, maybe a money market for that 6 months out to 1
say
year
1 to
to
2
2
months.
years?
1 to 2 months, I
Yeah.
think, and then
Yeah.
the rest. Because, like I said, even if it's a money market, or some type of like short-term bond fund, ETF, something like that, it's still gonna be readily available in a couple days.
Mhm.
You know what I mean? Most bills that you might have are not going to be instantaneous, where it's got to be right then and there. Say, let me pay it, or like I said, if you want to, we talked about leverage. If you want to leverage credit card that gets you points, and as long as you're diligent and disciplined to paying off that credit card every single month, then those points can give you an added benefit for using it.
Well, the one thing you have to be careful about, though, is we just mentioned maybe putting it into an ETF, a short-term yield. Look at a 22. Look what happened to 22.
Right. Something that's got
SHY
very
was
short-term
down,
maturity, duration, things like that.
But still, when interest rates go up, and we're talking the interest rates on our borrowing power, the interest rates that we earn money on go down. And even if you were in SHY or one of the short-term yield bond
ETFs,
funds,
yep.
ETFs, then you would have been very sad that you saw some of your money that you thought was there for emergencies lost money.
Right. But it's not
Gotta
going to be
be
a
careful.
dramatic downside.
You still have to be
We're not
careful.
talking about like 10%.
No, we're not. But still, for
But
people
good
that think,
good point.
you got to remember the audience. When people talk about conservative, people think conservative investing is not volatile, that they're immune to some volatility. And that's not true.
Right.
Simply not true.
Good point.
Yeah, that's right. And even if we think about the Federal Reserve when they raise and lower rates, one of the things that most people don't understand is that the Federal Reserve, when they change rates, they're only changing the overnight rate.
Right.
And so what we saw in 2022 when the Fed was raising rates, if you were invested in an ultra short money market type instrument, your yield would have adjusted upwards with a slight lag, right? A slight delay.
Right.
But if you were longer term,
Ooh,
if you were that 5-year or 10-year, then your return, your principal was very volatile, and
Right.
you experienced some principal decline. So that's why I think for that 1 to 2 month emergency fund, checking, savings, high yield savings, money market accounts are probably the most appropriate. The other thing to consider while I'm talking about raising rates, when the Fed lowers rates, those are also the products that are going to have lower interest rates,
Right.
and it'll be felt almost immediately. But the principal balance isn't going to be as volatile.
Right.
Yeah.
Very true.
Next up, how should I plan for major once-in-a-lifetime expenses like elder care, special education, or a wedding without derailing long-term goals? If you're helping a loved one or planning for a family milestone, share your question at trajanwealth.com/5QIQ. All right, major once-in-a-lifetime expenses.
I'm in the middle of one.
Mm.
My daughter's getting married in October of 2027.
Congratulations.
Thank
At least you
you.
got some time.
No, my gosh. And so I don't say I'm planning for a wedding. What I'm paying for is a marriage. And
You don't have to.
I don't have to, but I believe in them. So first of all, if you're going to go, I don't want to get off on a tangent, but planning for a huge expense like a wedding,
Right.
make sure that you believe in the people that are getting married before you're willing to put down a chunk of change.
Yes, that's a given.
Okay. Because if you don't believe in that, then let's go to Vegas. But I believe in,
Or just put it on the courthouse.
I believe in this wedding with this marriage with my daughter and my future son-in-law. This is something that I have to truly put aside.
Would you rather blow $50,000 on a wedding compared to, hey, you know what? Spend $5,000. I'll give you $45,000 down towards a house.
We've had the conversation. We've had that conversation, and the jobs that those two, their career paths, they'll have that down payment. They really, really want to have the most special moment possible.
They've watched.
I'm trying to choose my words.
They've watched too much TV.
I have to. No, and I believe in that. I really do. Having those wedding photos and those moments captured for them to look back on their lifetime together, I think are very, very special and important. I don't have that, and that's something that I look back on my life and I kind of wish I could have.
So let's ask you, David. How long have you been married for?
26 years in July.
Okay.
And how many children?
Shh.
Oh.
How many times have you looked at your wedding photos in those 26 years? Twice?
Just a handful that I can recall.
Right.
What about your wife?
I don't know. I don't know.
I'll bet she's probably about one and the same.
Yeah, probably.
So my point being is that yes, the event of a wedding is awesome, but the ability to really know that, okay, having that money towards a house, which yes, they might be the right career paths. Maybe I'm a little bit jaded because I got divorced about 2 years ago.
You did.
So the ability to know that, because I was thinking about that same question for me. And same thing, I was married for 22 years. We probably looked at those wedding photos maybe, like you, maybe twice after the initial 6 months.
My daughter-in-law, and when we get together, we watch their wedding video every single time, and we still cry every time. Every time we get together, I can't even tell you how many times I've watched that wedding video.
Are you sure it's not the movie Ghost?
It's not my wedding video. My goodness. Anyway, so that's one. So you just, you have to plan for these events, right? So those are events you can plan for. How about the unforeseen events, right? You can't plan for your air conditioner going out.
Healthcare stuff, things like that.
Healthcare, you can plan for healthcare. You can get insure yourself.
Well, yeah, you can, but you're still going to have to get max out of pocket, things like that. So
elder care, I mean, things happen, especially as our parents and grandparents age.
Well, the problem, it's not a one-time event though. It starts off, but then if it is elder care, okay, now I've got a monthly payment to pay for my dad in a long-term care facility. So that's even harder to plan for. It's like, hey, yep, I need $20,000 for this just in case. Well, no, it's $5,000 a month.
You can insure for that too.
Well, you can, but
not just through long-term care insurance. You can get life insurance policies that could consider. You can put a life insurance policy on that person,
and then you just put the pillow over their face,
and then everyone gets to party. No, but there are life insurance policies, even term policies, that allow you to draw down the death benefit. You just have to understand which ones you need to purchase.
So I'll use myself as an example. My wife and I have a son and 3 daughters. So when we think about planning, obviously I have 3 potential weddings in the future. My son is married now. And so we have those 3 potential weddings that we have to think about now and start planning for. My mom is getting older. She's 75 years old. And so it's like, all right, well, how do I help support her if there's a situation where she
Mhm.
can't, reasonably manage to take care of herself? So I think, we're talking about kind of a once in a lifetime type expense, but if you take a step back and think about it, it's like, well, these events could happen, so I better start planning for it today.
Mhm.
Right.
Right.
That's my thought.
Right. So now let's talk about special needs children.
Mm,
So now you've had your first child, and
Yep.
your first child has special needs, but maybe they can still go to school. You're not
High
sure.
functioning, right?
Right, high functioning. A traditional 529 plan probably wouldn't be appropriate for them,
Correct.
especially if the potential for government benefits is there.
Absolutely.
So maybe consider an ABLE account, ABLE, ABLE account, which
Yep.
is specifically designed for
Special needs.
special needs that will not impact their ability to have government benefits. So there are things like that that you can potentially plan for.
True.
A trust
And it will help.
will help.
It's definitely a special needs trust.
Yeah.
For sure.
For sure.
At the very minimum.
Hmm. So budget, do your budgeting first for different events.
Right. If you know it's going to be coming up, for sure.
Yeah. Don't go too far into debt. Make sure you can manage your debt to handle, we don't, again, unforeseen circumstances. Make sure that you carry a reasonable amount of debt if you're going to carry debt, and the type of debt, manage that debt appropriately, versus a house and a car, credit
yeah.
card debt, things like that.
Definitely. Especially credit card debt. That's the worst kind.
Yeah, that's a
Because
silent
you might be
killer.
paying 28%, which is
Oh, for sure.
Yeah.
ridiculous.
So I think the key is start planning today.
Yep.
Just think about
Mhm.
it and start planning today, and don't use debt. Don't wait till the last minute to start planning. Don't use
Right.
debt if you can avoid it.
Hmm.
So yeah,
Yeah.
I think those are all good
That's a great
points.
question.
Love it. Now to our final question today. What's the best way to coordinate company stock, options, tax timing, and diversification after a liquidity event? Okay, so you work for a company.
Yep.
20, 30 years, and part of your compensation is in company stock or restricted shares, RSUs,
Hmm.
and you're getting close to retirement. How do you think about diversifying or managing that large position in that company stock?
You never want a single stock to have 25% or more of your entire net worth. You're just taking on too much risk, especially if you're working for the company on top of that. So if you're working for them and you've got RSUs that are coming up, typically RSUs are going to automatically invest on that part. In fact, I just brought on a client who worked for Carvana, and he has stock options, and he doesn't even have a choice. Every single month they vest and exercise. So he
Oh
doesn't
my
have
gosh.
a choice to
On an
hold it
RSU?
on options compared to RSUs. But I mean, there is no choice. It is like every single month they exercise and sell on those things and give it to him. So he
Mhm.
has no choice compared to, hey, I'm going to hold some of these because maybe it's lower now. He's got no option. So for him, it's a little bit different story because it happened automatically. But for, I know for some of the other companies that are out there, you have different choices. But I think the real key is that hey, when you're going to have, the biggest thing I think is for like a big liquidity event. So if the company's getting bought out and all those things, and you have all these RSUs that were here, and then poof, all this, and then the stock's going away, you have no control over that. So you're gonna get, if it's say $500,000 or something like that, you're just gonna have to take it and love it, and say, okay, now I've got this cash. How can I, invest it to get the kind of returns I had before, which may not be possible. But I think the main thing is that, knowing that, okay, not having so much overexposure to a single stock is probably the best way to put it.
So typically, when you are granted your RSUs, your ISOs, when they're going to be vesting.
Right.
Right. When the exercise dates come
Typically
up.
4 to 5 year schedule.
And they're taxed differently. So when you have a restricted stock unit, when you want to exercise on that one, it comes in as ordinary income.
Yep.
Then you need to hold it for a year, afterwards, so that you'll pay long-term capital gains taxes on it. So you don't want to exercise the option and then automatically sell it all.
Right.
right? Because you can inadvertently be triggering a much different type of a taxable event. Not only do you have ordinary income, but potentially now you also have short-term capital gains
or AMT, alternative minimum tax.
So it's going to depend. That's not that question is not, here's your answer.
Right.
It's going to be determined by what is your personal situation. Also, all the different tranches that you have that are getting ready to vest.
Right.
Can we, are some of them, can we show a loss on? It's going to be determined by your personal situation.
Right.
Right.
Well put.
The other thing I'll point out, so one, I'll have a comment regarding diversification. So this was, again, over a couple of decades ago. I had met with a client that worked for Williams Companies,
Yep.
and this would have been right around 2003. Remember what was happening? Natural gas, Enron. This was right
WorldCom.
WorldCom. This was right on the heels of Enron. And so he had his personal net worth in Williams Company stock, and he was employed there. And of course, during that time, Williams Companies just dropped. I mean, I think they were right around, if memory serves, right around $1 a share. So he saw his net worth just evaporate.
Yep.
And going back to the discussion on biases, loss aversion, he sold when it was at $1 a share.
Yep.
So because he had such a large concentration in that company stock, he took the loss in his personal net worth and had to continue working even when he didn't want to try to make up the difference. So my point there being is, to the extent you can, diversify, set a target. I like your idea of 25% of your total net worth. That's not your investment accounts, it's your total net worth.
Right.
And make sure you stay diversified. The other point that I'll make is when if you work for a company and let's say you're considered a company insider.
Right.
There's only a window, even if you have RSUs and they've converted to stock, there's a certain window that's available to you to sell that company stock.
Right.
As long as you're not, as long as you don't have material non-public information, you can generally sell it. So one of the options that some investors, especially those that are in an executive level, is they can put it in a 10b5-1 plan, I believe is what it's called, which is where essentially it's like a blind.
Oh, you have a schedule.
Yeah.
Kind of set up.
Yeah, it's a schedule. And you sign the 10b5-1 and it sells over time. And so it takes the emotional decisions away from you as the employee, but also it helps you liquidate and diversify over time, which I think is a smart move.
Absolutely.
So remember, RSUs are taxed at the time of sale.
At the time of exercise.
At the time of exercise, right? Or inside of your 401k plan, the company stock that you've been purchasing inside of your company, your 401k plan. Now you have net
appreciation.
Yeah, you can look at if you're rolling over. Let's say you're done working and you want to do an in-service rollover. You want to roll over. At that time, it has to be everything rolls out.
Right.
You can't just say, hey, I only want to roll this out. It has to be the whole thing. But you have the net unrealized appreciation of that company stock that you have the ability to.
As long as you've got a good low basis.
Well, again, personal situation is what's going to determine if it makes sense to do that anyway.
Yep.
Yeah.
Very true.
What that does do is that gets a bunch of money out and tax it already. So if you have a couple $1 million in your 401k plan.
And it's got a cost basis of like $50,000.
Might make a whole lot of sense to let's make that taxable money now or non-tax.
Huge. And avoid
after
RMDs
tax.
later on down the road.
Yep.
Huge.
Yeah. So again, consult your professional.
Yep. Exactly.
There's stuff that you don't even know about that's out there.
A firm like Trajan Wealth that has everything underneath one roof: tax planning, wealth management, and estate planning.
And Corbett, we have you under one roof, which is where we want you. You need to be contained.
Thanks.
That's right. So today we've talked about behavior, leverage, cash reserves, major family expenses, and the complexity that can come with a bigger career event. The common thread is resilience, building a plan that can absorb stress without falling apart. If one of these questions sounds like your life, send it to trajanwealth.com/5QIQ. Share this episode with someone who needs a stronger safety net. Plan smarter, dream bigger. Thanks for joining 5QIQ Financial Power-Ups with Trajan Wealth. We'll see you next week.
Trajan Wealth, an SEC registered investment advisor. Additional services through Trajan Estate and Trajan Tax. Information discussed during this program is intended for illustrative and entertainment purposes and is not investment advice or an offer to buy or sell any investment. Please consult your financial advisor for questions about your financial situation. All investments involve risk and the potential for loss. Any examples given are strictly hypothetical. Your results may vary. Additional disclosures at TrajanWealth.com.